Let's talk about something that actually matters: life insurance. Meet Maya and Liam, both 28, new homeowners and suddenly aware of their financial responsibilities. They're at that stage, earning more but also taking on real debt. Over coffee, the topic of life insurance comes up. Liam wants something simple and cheap, just enough to cover the mortgage and protect his partner. He's after a safety net, nothing fancy. Maya, on the other hand, is thinking long-term. She's heard some life insurance can double as an investment, building wealth over time. She wants her money to work for her, even in insurance. So, two friends, two philosophies: simple protection, or a financial tool with extra perks. This isn't just about Maya and Liam, it's about a choice you might face. Do you pick the affordable, straightforward option or the pricier, more complex one with added benefits? It's like choosing between a reliable Toyota and a feature-packed Tesla. Both get you there, but in different ways. Which one fits your life? Let's break it down. Liam's choice? Term life insurance. Think of it like renting. You pay for coverage for a set period, 10, 20, or 30 years. If you pass away during that time, your family gets a tax-free payout. If you outlive the term, the policy ends. Simple. The big advantage? Cost. Term is dramatically cheaper than other types. For a healthy 28-year-old, a $500,000 policy might cost as little as a couple pizzas a month. That means you can get a lot of coverage without wrecking your budget. Term is perfect for covering temporary needs, like a mortgage or kids' education. It's a financial bridge for the years your income matters most. But here's the catch. When the term ends, so does your coverage. If you still need insurance, you'll pay much higher premiums as you age. So, term is a great tool for a specific period, not a lifelong solution. It's the just-in-case plan for your most vulnerable years. Simple, affordable, and targeted, but not forever. If you want lifelong coverage, you'll need something else. Let's see what Maya's considering. Maya's looking at whole life insurance. Unlike term, whole life covers you for your entire life, as long as you pay the premiums. The big draw? It never expires, and your beneficiaries are guaranteed a payout. But there's more. Whole life builds cash value. Part of your premium goes into a savings account that grows over time, tax deferred. You can borrow against it or even cash it out, though you'll lose the death benefit if you do. For some, it's a forced savings plan, separate from the stock market. But all these features come at a price. Whole life can cost 5 to 15 times more than term. That's why it's often used by high earners who've maxed out other retirement accounts. It's a complex product with a hefty price tag. For the right person, the combo of lifelong protection and savings is appealing. But for most, the cost is a major hurdle. Whole life is a commitment. Make sure it fits your goals. Now let's compare the two. Let's put term and whole life head to head. First, price: term is cheap. Whole life is expensive. Term is temporary, perfect for covering debts or income needs for a set time. Whole life is permanent. Coverage lasts as long as you pay. Simplicity: term is straightforward. Pay the premium, get coverage, that's it. Whole life is more complex with cash value, loans, and fees to consider. So, which is better? It depends on your needs. Term is for those who want maximum protection for the lowest cost, like Liam. Whole life is for those with lifelong needs, who want to save and can afford higher premiums, like Maya. There's no universal winner. It's about matching the tool to your financial job. Are you covering temporary risks, or do you need lifelong coverage? Do you want simple and affordable, or complex with extra features? Your goals and budget decide. For most, term is the answer. But for some, whole life makes sense. Let's wrap it up. So what's the move? For most people, term life insurance is the smart play. It gives you the most protection for your dollar when your family needs it most. The classic advice: buy term, invest the difference. The money you save can grow in a 401k or IRA, building a bigger nest egg than whole life's cash value. But whole life isn't always a bad deal. It's useful for estate planning, lifelong dependence, or forced savings, if you can afford it. Ask yourself, what problem are you solving? If it's protecting your family for 20 years, term is your answer. If you need lifelong coverage, whole life might fit. Start with your needs, know your budget, and don't get dazzled by sales pitches. For most, term plus smart investing is the winning combo. If you learned something new, please subscribe, like, and comment.